Let me start with a question. If you could instantly lower your monthly bills, access tens of thousands in cash, or pay high interest debt without selling your home, would you do it? For most Canadians, the answer is absolutely. But here's the truth. Most homeowners don't fully understand how refinancing works in Canada. And when you don't understand something this important, one of two things happen. You either miss out on opportunities that could save you thousands, or you make costly mistakes that you'll regret in years. Today, I'm going to change that. Over the next little bit of time we spend together, I'm breaking down everything you need to know about refinancing your mortgage in Canada, from the basics to the math to the strategies that can save you real money. By the end of this video, you'll understand what refinancing is and what it isn't, the main reasons Canadians choose to refinance, the exact process step by step so that there are no surprises, and the 3 proven refinancing strategies to avoid costly mistakes and maximizing your savings. But before we get into how to refinance, we need to start with why. Because refinancing isn't one size fits all. The reason you refinance determines whether it's worth doing or whether you should wait. Reason number 1 is lowering your interest rate. Interest rates in Canada move in cycles. If you locked into a rate, say in 2023, when rates were peaking, the rates have dropped since. Refinancing can replace that expensive mortgage with a cheaper one. This can save thousands every month and tens of thousands over the life of your mortgage. Reason number 2, assessing your home's equity. As you pay down your mortgage and your property value increases, you build equity. That extra equity can fund renovations, investments, or help your kids with a down payment. The possibilities are wide open. Reason number 3 is consolidating high interest debt. Credit cards at 19% interest, personal loans at double digits. Many Canadians are carrying expensive debt that's eating away at their monthly cash flow. Rolling those balances into your mortgage at a much lower rate can be a game changer. Reason number 4, changing your mortgage term, switching from variable to fixed for stability, extending your amortization to lower payments, or adding or removing a co-borrower. Refinancing is your chance to reset your mortgage to match your current situation. Now, this all sounds good, right? But here's the catch. Breaking your mortgage early usually comes with penalties. Sometimes that penalty can wipe out the benefits of refinancing if you're not careful. So we're going to go deep into how refinancing actually works in Canada, from the numbers to penalties to lender types to qualification rules. And if you stick around to the very end, I'll give you 3 strategies that can save you thousands of dollars and help you decide whether refinancing is right for you. So let's break it down. How does refinancing actually work in Canada? Step number 1 is figure out your number. Before you even talk to a lender, you need 3 key details: your current mortgage balance, your home's estimated market value, your mortgage type, fixed or variable. Your mortgage type determines your penalty. Your balance tells you how much equity you have, and your home's value tells you how much equity you can borrow. Here's the math. Let's say that you have a home worth $800,000. 80% of that is $640,000. Subtract your current mortgage and let's say that it's $500,000. You can have up to $140,000 that you could potentially access. Step number 2 is calculate the penalty. This is where many Canadians are shocked. If you're in a fixed rate mortgage, your lender will likely use an interest rate differential, known as an IRD calculation. That means they compare your current rate to their posted rate for the remainder of the term, and the difference determines your penalty. As an example, if you have a $500,000 mortgage at a rate of 5.5% with 2 years left, the lender's posted rate for the remaining term could be much higher than that. Let's call it 7%. That's a 1.5% difference. Multiply that by your balance, prorated with the remaining term, you could be facing a $15,000 penalty. If you're in a variable rate math, the math is easier. Usually it's 3-month interest. On a $500,000 mortgage at 5%, it's about $6,250. Step number 3, requalify under today's rules. Refinancing is like getting a brand new mortgage. That means you'll need to qualify based on your current income, credit, and debt ratios, even if you owned a home for years. And yes, that means the stress test applies. You have to qualify at the higher of your rate plus 2% or the Bank of Canada's qualifying rate. If your refinancing rate is 4.5%, you may need to qualify at 6.5% or higher. This is where some people hit a wall, especially if income hasn't grown with qualification standards. Step number 4, choose your lender type. In Canada, you have three main options. Big banks. They're familiar, stable, but restrict qualifications and less flexibility. You also have credit unions, can be more flexible, especially with certain income types, but often require provincial residency. Alternative or B lender are higher rates but looser guidelines if your credit or income is outside of the box. Step number 5, closing your refinance. Once you're approved, a lawyer or notary registers the new mortgage, pays off the old ones, and sends you the remaining funds. You'll pay legal fees, appraisal costs, and possibly title insurance. The pitfalls to watch for: penalties eating away at your savings. If you have $500 a month in savings, but the penalty is $12,000, it may take you 2 years to break even. If you're not staying in your home that long, it could be a bad move. Timing the market poorly. Rates have dropped from their 2023 peak, but they're still higher than the pandemic lows. Waiting could get you a lower rate, but prices or lending rules might change. Emotional refinancing. Funding a renovation or helping your kids can be great, but it shouldn't push your payments beyond what you can handle. In short, refinancing is not free money, it's a tool. And like any tool, using it wrong can do more harm than good. So now let's talk about how to use refinancing the right way, the strategies to follow, the mistakes to avoid, and how to know if it's the right time. All right, so now you understand the why and the how. Now let's talk about the smart ways to refinance. Strategy number 1, refinance at renewal. This is the easiest way to avoid penalties. When your mortgage term ends, let's say 3-5 years from when you took your original mortgage, you can switch lenders or change terms without a breakage fee. If you know you're going to need to tap into the equity in your home, plan ahead and time it with your renewal. Strategy number 2 is blend and extend. Some lenders let you blend your current rate with today's rate and extend your term. This can lower the penalties while giving you access to the equity. Not always the cheapest, but worth asking about. Strategy number 3 is strategic debt consolidation. Rolling in high interest debt into your mortgage can save thousands, but only if you don't rack it up again. Use it as a financial reset. Now here's the mistakes to avoid. Ignoring the penalty. Taking the first offer from your bank without shopping around. Forgetting about the stress test when planning your refinance. So should you refinance now or wait? It comes down to math and timing. If the savings outweigh the penalties and it fits your long-term plan, refinance can be a powerful move. So should you refinance now or wait? It comes down to the math and timing. If the savings outweighs the penalty and fits your long-term plans, refinancing can be a powerful move. If not, it might be better to wait for your renewal or until rates or your financial situation improves. So here's your next steps. Run the numbers with a mortgage professional who understands the Canadian market. A good broker can tell you within minutes whether it's worth exploring, and if it is, shop dozens of lenders to make sure that you're getting the best deal. I'll leave a link in the description where you can book a 15-minute call with me. No pressure, no obligations. We'll just run through the numbers together, because when done right, refinancing can lower your payments, free up cash, and give you more control over your financial future. If this video helped you understand refinancing in Canada, hit the like button, subscribe for more Canadian mortgage tips, and share it with someone who might need it. I'm Justin Chausse, and I'll see you in the next video.